Today, we will talk about top ways of money management tips to improve your finances. So before we get started, make sure to hit that like button, also subscribe to my channel. 1. Track your spending to improve your finances. If you don't know what and where you're spending each month, there's a good chance your personal spending habits have room for improvement. Better money management starts with spending awareness. Use a money management app like MoneyTrack to track spending across categories and see for yourself how much you're spending on non-essentials such as dining, entertainment, and even that daily coffee. Once you've educated yourself on these habits, you can make a plan to improve. 2. Create a realistic monthly budget. Use your monthly spending habits, as well as your monthly take-home pay, to set a budget you know you can keep. There's no use setting a strict budget based on drastic changes, such as never eating out when you're currently ordering takeout 4 times a week. Create a budget that works with your lifestyle and spending habits. You should see a budget as a way to encourage better habits, such as cooking at home more often, but give yourself a realistic shot at meeting this budget. That's the only way this money management method will work. 3. Build up your savings, even if it takes time. Create an emergency fund that you can dip into when unforeseen circumstances strike. Even if your contributions are small, this fund can save you from risky situations in which you're forced to borrow money at high interest rates, or possibly find yourself unable to pay your bills on time. You should also make general savings contributions to strengthen your financial security in the event of a job loss. Use automatic contributions, such as FSCB's Pocket Change, to grow this fund and reinforce the habit of putting away money. 4. Monitor your taxes. When a company offers you a starting salary, calculate whether that salary after taxes meets your financial needs and savings goals. Many online calculators help you see your after-tax salary, such as PaycheckCity.com, and chart your gross pay, total earnings, and net pay, earnings after taxes, and other deductions or take-home pay. In 2023, an annual salary of $35,000 in New York netted $28,461 after federal and state taxes, or about $2,372 per month. In the U.S., low-income earners are taxed at a lower rate than higher-income earners. The higher your salary, the higher the tax rate. A salary increase from $35,000 to $41,000 a year looks like an extra $6,000 per year or $500 per month. But the tax rate will be higher, so it will only give you $4,463 or $372 per month. 5. Protect your wealth. If you rent, get renter's insurance to protect the contents of your home from loss due to burglary or fire. Read the policy carefully to see what's covered and what isn't. Disability insurance protects your ability to earn an income by providing you with a steady income if you are unable to work for an extended period due to illness or injury. If you want help managing your money, find a fee-only financial planner to provide unbiased advice. Unlike a commission-based financial advisor, who earns money when you sign up with the investments their company markets, a fee-only planner can provide advice in your best interest. 6. Save up cash to afford big purchases. Certain kinds of loans and debt can be helpful when making major purchases, such as a house or even a car that you need right now. But for other big purchases, cash offers the safest and cheapest buying option. When you buy in cash, you avoid generating interest and creating a debt that requires months, or often years, to pay back. In the meantime, that saved money can sit in a bank account and accumulate interest that can be put towards your purchase. 7. Start an investment strategy. Even if your ability to invest is limited, small contributions to investment accounts can help you use your earned money to generate more income. Find out if your employer offers 401 matching, which essentially serves as free money. Consider opening a retirement account or other investment account. The path to better finances starts with changing your own habits. Some of these changes will be easier than others, but if you stay committed to this transformation, you'll end up with great money management skills that will serve you throughout your life. And in the meantime, you'll have more money in your pocket. 8. Learn to budget. Once you've read a few personal finance books, you will understand 2 rules. Never let your expenses exceed your income, and watch where your money goes. The best way to do this is by budgeting and creating a personal spending plan to track the money coming in and going out. Tracking expenses, like your expensive morning coffee, can provide a valuable wake-up call. Small changes in your everyday expenses are under your control and can impact your financial situation. Keeping monthly expenses, like rent, as low as possible can save you money over time and put you in a position to invest in your own home sooner than later. 9. Start an emergency fund. A mantra in personal finance is pay yourself first, which means saving money for emergencies and your future. This simple practice keeps you out of trouble financially and helps you sleep better at night. The tightest budget should put some money into an emergency fund every month. Once you get into the habit of saving money, you will stop treating savings as optional and start treating it as a required monthly expense. Many accounts offer the power of compound interest, such as a high-yield savings account, short-term certificate of deposit, CD, or money market account. 10. Save for retirement now. No matter how young you are, plan for your retirement now. With the power of compound interest, when you start saving in your 20s, you will earn interest not only on the principal you deposit, but also on the interest you earn over time, and you will have what you need to retire someday. Company-sponsored retirement plans are a great choice. Not only do you get to put in pre-tax dollars, but many companies will also match part of your contribution, which is free money. Contribution limits tend to be higher for 400 and ONEX than for individual retirement accounts, IRAs, but both are one step closer to financial health. 11. Pay with cash, not credit. Exercise patience and self-control with your finances. If you wait and save money for what you need, you will pay with cash or a debit card to deduct money directly from your checking account and avoid using a credit card. A credit card is a loan that accumulates interest unless you can afford to pay off the balance in full every month. Credit cards can help you build a good credit score, but use them for emergencies only. 12. Educate yourself. Take charge of your financial future and read a few basic books on personal finance. Once armed with knowledge, don't let anyone take you off track. Whether a significant other who encourages you to waste money or friends who plan expensive trips and events you can't afford. Research professionals like financial planners, mortgage lenders, or accountants before utilizing their services. 13. Guard your health. If you're uninsured, don't wait to apply for health insurance. If employed, your employer may offer health insurance, including high-deductible health plans that save on premiums and qualify you for a health savings account, HSA. If you're under the age of 26, you may be able to stay on your parents' health insurance, an option that has been allowed since the 2010 passage of the Affordable Care Act, ACA. If you need to buy insurance, investigate the federal and state plans offered by the health insurance marketplace of the ACA. Look at quotes from different insurance providers to find the lowest rates. Research all your options to see if you qualify for a subsidy based on your income. If you like this video and would like to see more like it, please give it a thumbs up, leave a comment, and click to subscribe button.